Okay, this is chapter 6, problem 8. This is actually one of your homework problems. Project evaluation. Doug Franks is looking at a new sausage system with an installed cost of $375,000. This cost will depreciate a straight line over the project's 5-year life, at the end of which the sausage system will be scrapped for $25,000. The sausage system will save the firm $95,000 per year in pre-tax operating costs. The system requires an initial investment in net working capital of $15,000. A tax rate is 24%, and the discount rate is 10%. What is the NPV of this project? So I've set up a table. So our net cost, go to the initial cost, is a negative $375,000. Okay. So our then it's generating savings of $95,000. So what I do here, I just have it set up for sales. So savings and sales would equate to the same thing. Or I could actually enter it as a negative if I chose to. In costs, depreciation is going to be a negative 375,000 divided by the 5-year life. So now I just the savings don't change, so I can just pull this over. And now my depreciation is not going to change either, so just copy this down. All right, so now I've calculated my net income. The project, let's go back. The project requires $15,000 in net working capital. So that's so the $15,000 is a cost at the beginning, and then at the end it's an inflow. So it's outflow in the beginning because you're taking that money away, and then you get it back when the project's over. So I can just do a negative the 15,000. So now I've accounted for that. Now the salvage value is 25,000. So after tax salvage value just equals the salvage value multiplied by 1 minus the tax rate. So now salvage values of inflow. Again, the reason you pay taxes on it is because you fully depreciated the project over the life. So if we look at our depreciation up here, you highlight this. We can look down here. The sum is $375,000. So we fully depreciated this $375,000 initial cost. So that becomes a taxable event. It's very similar to if you happen to own a rental property. You depreciate it over the life, and then when you sell it, it becomes a capital gain. So, all right. So to calculate the NPV, equals NPV. So our rate is 10%. Then comma. Then we highlight our cash flows here, and we close paren. So again, the cash flows after the initial costs, and then we add back the initial costs, and we get an NPV of negative $26,959.71.